Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. On today's episode, we're going to see how to apply all of the concepts we learned from the balance sheet, the income statement, and the cash flow statement into analyzing a current real-life company. And for this, I'm going to analyze companies in the stock market because all of the information of these companies is publicly available for anyone that wants to see it. For analyzing all of this company, I'm going to share my screen, but also you could do it yourself by going to finance.yahoo.com and then looking for any company that you're interested in analyzing. Today, I'm going to do an example comparing Amazon and Apple, two of the most important companies in today's world and two of the highest valued in the stock market as well. I'm going to start by showing you how to access all of the company's financial statements. And basically, after you find the company in Yahoo Finance, you should go to the Financials tab. And after you press over there, you'll find the income statement, the balance sheet, and the cash flow. For analyzing those three statements, I told you we should always look for three important values in each one. In the income statement, we should always look for the gross profit, the operating income, and the net income. So let's start looking at Apple's gross profit. We can see that this value comes from the total revenue, which are Apple's sales, minus the cost of that revenue. For Apple, in this case, it's $166 billion, as all of these numbers are in thousands. So this means that the company, after taking away all the costs related to those sales, is having a gross profit of $166 billion. When we take away all of the operating expenses, which is going to be mostly R&D and the selling and administrative costs, we're going to get to the operating income. Also, a very important value is it will give us the profitability of the operations. We can see with Apple, it's still pretty high. After that, we'll take away other income expenses, but most importantly, we'll take away the tax, and then we'll get to the net income. This value is the bottom line. And as I had shown you, this one is one of the most important ones, as it will give us the net profits or the net earnings of a company. For Apple, year-to-date, it's $95 billion. This value, we're going to then pass it on to our balance sheet. I don't know if you remember when, but in the balance sheet, we'll have to put this net income into our retained earnings. Retained earnings belong to the equity part, and basically the retained earnings are capturing all of the earnings a company has had since its inception. So for calculating the retained earnings, you take all of those retained earnings and you add this net income that we just saw in the income statement minus the dividends that the company is giving away. So now let's switch up to the balance sheet and let's look to the three important values that I told you should look for: total assets, total liabilities, and total equity. Total assets should always equal total liabilities plus total equity. And we see this is what's happening with Apple and with every stock that you'll find in the stock market. The total assets can be split into the current assets and the non-current assets, and you can expand all of those values in Yahoo Finance or looking at Apple's financial statements. As you can see, you'll see all the cash, the receivables, the inventory, or the investment that Apple is doing to watch its current assets and its non-current assets. Then you can also analyze the total liabilities into current liabilities and non-current liabilities. And if you don't remember, current liabilities are those that are due in a short amount of time, so usually 1 year or less. And then non-current liabilities are those that are going to be due in more than a year from now. Finally, we can also see the total equity. And Yahoo Finance is also making it easier for us because they have other important numbers here, such as the shares issued or the net debt and the total debt that a company is having. So this is going to help us facilitate all of this analysis of the liabilities and equities. Now, if we move on to the cash flow, we're going to start seeing here the three important values that I told you should look for in cash flows: operating cash flow, investing cash flow, and financing cash flow. After you add all of that, that would give you the free cash flow, which is the final cash position of a company. The operating cash flow, as I told you, should always be positive, as this is telling us that the company's sales and operations are being profitable and are giving the company a positive cash outcome. The operating cash flow of Apple is $109 billion, which is healthy. Then, when looking at the investment cash flow, I told you, hopefully this value should be negative, as it means that the company is investing all of this money to having future earnings. Apple's investing cash flow is very negative, but not as much when we compare it to last year, for example, when it was almost 3 times the size as it is currently now. Finally, you can also look at the financing cash flow. And I told you this one should also hopefully be negative, as this means the company is paying out its debt. For Apple, it's negative, and currently it's negative $118 billion. So when you add all of those numbers and then also get the issuance of that, repayment of that, and other values, we'll get that Apple's free cash flow is a very high amount. This is $97 billion. So Apple, it's closing up its year with $97 billion, basically in cash, but this comes from how the money is moving within the company. What's important here is that it's positive. And so as you might see, all of the numbers in Apple are fabulous, and that's why it's such a great valued company. But now let's study Amazon, which is also one of the most popular companies, but you'll see that some of those values are changing a little bit. So when we look at Amazon's financial statements over here in the financing tab, we'll start with the total revenue, which is also a very high amount. But when we start looking at the gross profit, the operating income, and finally the net income, we'll see that after taking away all of the expenses from sales, from operations, and from taxes, Amazon's net income is negative. And why can this be true? Sometimes companies have a really high cost of revenue, or it might also be a cost of operations, which comes from R&D or doing different expenses that a company might have. So if you want to further analyze this, you could look at the total revenue expansion over here in Yahoo Finance to see what's Amazon having all of these expenses. The second thing that we should look for is the balance sheet. Even though this one will only show us the balance between the other statements because it's giving us total assets, total liability, and total equity, but we see also that similar to Apple, Amazon has a big debt and a big number of shares issued. From here, we can't really get a lot of numbers. I'm going to show you then the ratios that we'll use, but I'm going to move on to the cash flow to show you something extremely interesting in Amazon. So Amazon has a positive operating cash flow. As I told you, this would be for a healthy company. And they have a big investing cash flow, a big negative amount, which means that the company's spending a lot of its money into future income or like future expected income. But these values are so big in the investing cash flow that the company, Amazon, is ended up with negative free cash flow for the past 3 years. Since 2021, Amazon has ended up with a negative cash flow. And what does this mean? It's not really negative per se. It just means that the company is spending more money right now than it's earning. And it's finishing up every year with negative amount of cash in their pockets, so to say. So if we see year to date, Amazon has a negative $17 billion cash flow. And last year it was also similar, negative $16.89 billion. And in 2021, it was negative $14.76 billion. So this means that the company is investing a lot of money, but this is currently giving them a negative cash flow. So how can we know if this is good or bad? We can't really judge a company just by looking at these numbers. So what I wanted to propose to you today is looking at the ratios that are going to give you a better overview of the company. And then, if you want to further expand on them, you can look for the company's income statement, cash flow statement, and the balance sheet. So, 4 ratios are going to be very useful for analyzing a company's financial health. The first one is going to be the EPS, or the earnings per share. This one is going to tell us how much a company is earning for every share that it has outstanding. If we look at them, we're going to see them in the Summary tab in Yahoo Finance. Amazon's EPS is 1.26, which means for every share out there of Amazon, the company's creating $1.26, which is a very good amount. But now when we're looking at compared to Apple, Apple's EPS is extremely high. It's $5.97, which means every share out there is Apple is earning $5.97 for that share. Another important ratio that we're going to look for, knowing the profitability, will be the profit margin. And this one we can find it in the Statistics tab for each of the companies. Here, if we look at the profitability for Apple, we'll see that their profit margin is 25%, which is going to show us they have a big margin when it means to earning and being profitable. Amazon's profit margin, if we compare it over here, it's still going to be positive, but not as high. It's going to be 2%, so almost 10 times as smaller than the Apple one. A third ratio that will give us a hint on how the company is being financed specifically would be the current ratio. And this one we can find it on the financing part, and it will show us how a company is financing its current liabilities with its current assets. So, if we look at the current ratio for Amazon, we can see that it's 0.95. So if we took out all of the current assets of Amazon and split them by the current liabilities, still Amazon wouldn't be able to pay its debt, but only for a small amount. And this, it's usually what's happening with companies, as they have higher current liabilities than they have current assets. It's going to be similar for Apple, as we can see that the current ratio for Apple, it's going to be 0.98. They're closer to 1, which would be the balance, but this doesn't mean a company is in a bad statement. It just means that 1, a company would be able to pay all of its current liability with its current debt. Finally, the fourth ratio I want to look at would be the return on investments. And this can be the return on equity or return on assets. And for this one, we're going to look at the return on equity, as this is what we care for as investors. Apple's return on equity is extremely high. It's 160%, which means it's managing very effectively all of the investments they're having. When we look at Amazon and we want to see the return on equity, it's positive, which is good, but it's 8.71%. So if we look for all of these values and we compare them, we can see that Apple's ratios are showing a healthier company than Amazon, but mostly because Amazon is investing a lot of its money into future growth. Now, all of these ratios that we're looking at are only giving us the health of the company's financial position, but they're not talking about the company's valuation in the stock market. And I haven't entered into that because that's not going to be really about a company's well-being. We can see that the stock market may overprice or underprice some stocks, and this is not going to be seen on this ratios, but on other ratios. I'm going to show you 4 ratios that are going to talk about a company's valuation instead of its financial health. The first of all of them would be the market capitalization. And this one is the one that's usually used for telling if a company is the most valuable in the world or not. Apple, being currently the most valuable company in the world, has a market capitalization of almost $3 trillion. This market capitalization basically comes from taking all the shares outstanding of a company and multiplying it times the price. So this is giving us a big amount of Apple. When we have Amazon's market capitalization, we would get that it's $1.45 trillion. It's still pretty high, and that's why Amazon is also one of the highest valued companies in the world. Now, a second ratio that I want to look for, or a second number, as these aren't really ratios, is the dividend percent. So some companies are giving a dividend, such as Apple, which pays right now 0.51% of the stock to its shareholders. Amazon, on the other side, is not giving a dividend. And this doesn't mean it's good or bad. It just means as a shareholder, you won't be able to gain money from that stock unless it's for growth of the company. The third number we're going to look at is the PE ratio, which is going to show us the price per earnings. So how much does the stock cost compared to the earnings the company is actually creating? If the price is very high, it will give us a high PE ratio, which means the stock might be overpriced. But on the other side, if it's a lower amount, it might give us a hint that the company is underpriced. So let's look at the PE ratio on Amazon and Apple. Amazon has a current PE ratio of 109, and Apple has a PE ratio of 31.74. This means that Apple is less overpriced than Amazon. And even though companies with a high PE ratio might grow even more, this is telling us that the stock market is behaving this way, and it's giving a higher price to companies that aren't earning as much. The final fourth number that you can look for when analyzing a stock, it's the beta. And this one is going to tell you the risk associated to this stock. So basically, how much is this company moving when it's compared to the S&P 500? When we look to Amazon's and Apple's beta, we'll see that this is relatively low. If it was 1, it would be saying us that it's moving the exact same way as the S&P 500, but for Apple is 1.29, and for Amazon is 1.26, showing that both of these companies aren't very risky, and they're behaving in a way that's similar to the S&P 500. After looking at all of these ratios, I hope that you can better understand how a company is performing and how it is behaving in the stock market. In my future lessons, I'm going to start diving deeper into financial accounting, but also into finance, so you can have those two possibilities of learning with